Hello traders, it's Friday, September 11th, and this is Alan Hong, market analyst of GKFXPrime. I'm gonna share my daily analysis through this video, and first of all, let's review the major market movements. So the first instruments referring to the dollar index in 4-hourly charts. So the US dollar index, which measures the greenback strength against a trade weight basket of 6 major currencies, was down 0.2% at 91.31 on Friday. So it was slumped to more than 2.5-year lows against a basket of the other major currencies on Friday, amid growing doubts over whether the Federal Reserve will be able to deliver another interest rate hike this year. So the index ended the week down 1.55%, which is the largest weekly percentage decline since late June. So the diminished expectations for a third rate hike this year is compounded by heightened tensions with North Korea and worries over the economic impact of hurricanes in the southeastern US pressures the dollar lower. So concerns over the political turmoil in Washington have also fed into the recent dollar weakness. So an agreement to postpone the US debt ceiling talks until December, which would call insight with the Federal Reserve policy meeting, have diminished the chance for a rate hike also. Meanwhile, the euro was ended slightly higher against the dollars, with the pair EUR/USD at 1.2036 after rising as high as 1.2092 earlier, so which is the highest level since January 2015. So the euro ended the week up 1.48% against the dollars, and it is up almost 14% against the dollar so far this year. So the demand for the single currencies continued to be underpinned after European Central Bank President Mario Draghi indicated Thursday that the bank may start tapering its massive stimulus program this autumn. While the sterling was rose to 5-week highs against the softer dollars, with the pair GBP/USD at 160.65% to 1.3195 on late Fridays. So the pound was boosted by stronger than expected data on UK manufacturing output growth. Having a tap in commodities markets, the gold price was rose to the highest level in a year on Friday and ended up 0.15% at $1,352.28 as the dollar remained under pressures amid the doubts over the prospect for a third Federal Reserve rate hike this year. So for the week, the gold price was rose 1.56%, which is its third consecutive weekly percentage gains. So the gold price is highly sensitive to rising rates, which leave the opportunity cost of holding non-yielding assets such as billions while boosting the dollar. As for the oil price, it was tumbled on Friday with the US West Texas Intermediate crude price sank $1.61 or around 3.3% to end at $47.48 a barrel by close of trade. So it was hit by concern over reduced demand as US refineries saw a slow recovery from flooding due to Hurricane Harvey. So the prices were further weighed as uncertainty gripped the energy market over the potential impact of Hurricane Irma as it approached the US. So 2 weeks after storm system Harvey knocked out roughly a quarter of US oil refining capacity, refineries along the Gulf Coast have been slow to restart and waging on demand for crude oil, the primary input at refineries. So the dip in demand was reflected in a report from the Energy Information Administration (EIA) on Thursday, showing the crude stockpiles was rose for the first time in 10 weeks. So Harvey's impact was also felt in the oil productions, which according to oilfield services firm Baker Hughes said on Friday, its weekly count of oil rigs operating in the US was declined by 3 to 756. Right, so but the slowdown in refining and output should be temporary. So in this week, investors will be closely watching Thursday's US inflation report for fresh clues on the possible timing of the next Federal Reserve rate hike. A monetary policy announcement by the Bank of England will also be in focus. Meanwhile, market participants will eye fresh weekly information on US stockpiles of crude and refined products on Tuesday and Wednesday to further weight that the impact of recent storm activity was on supply and demand of crude oil. So oil traders will also focus on monthly reports from the Organization of Petroleum Exporting Countries and the International Energy Agency to assess global oil supply and demand levels. So the data will give traders a better picture of whether a global rebalancing is taking place in the oil market. And now we're going to review the highlighted economic data and events on Friday, as well as the focus data and events for today, Monday. So last Friday, Japan will release its second quarter growth with the gross domestic products, which is at 0.6% growth, slightly disappointed than the economist focus at 0.7% growth. So besides of Japan, United Kingdom was released its manufacturing productions for July, and it was surprisingly better than the expectations of 0.3%, and the result was at 0.5% growth, and this is the main reason that's boosted the sterling's high yields on Friday, right? So during the North American trading hours, Canada as well released its employment change for August, and it was at 22.2 thousands, right? So which is better than the expectations. So the last data on Friday is the US Baker Hughes oil rig count, and it was decreased by 3 to 756. So for today, we got only one data from Canada, which is the housing starts for August, and it is expected to be slightly lower than the previous, with only 216k for August. And it's a technical analysis sessions, so first instruments we're referring to the Great British Pounds against the US dollars in daily charts. So the pair GBP USD remained traded in an uptrend, and it was close above the resistance level of 1.31500. So the both moving average lines will remain expanding upwards, additional with the bullish signals showing the MACD indicator suggesting to move further higher along with the uptrend. So the next resistance level we can refer to 1.326, and support level refer back to 1.315. While the single currency remained traded against the US dollar in an uptrend structures, but it failed to close higher than the previous high or the resistance level of 1.307. So it was formed a double top pattern with the neckline at 1.181. So it is a pattern that suggesting to move lower in short term as a retracement. So a closure below 1.197 will be signals to move further lower towards the next support level at 1.192. The Kiwi remained traded in a downtrend structure against the US dollars, but it was lost momentum since the price hovering between 0.723 and 0.734. So the both moving average line were pointing flat, additional with the both movement lines in the MACD indicator, which narrowing and moving flat. So NZD USD, the parent NZD USD is expected to be ranging between 0.723 and 0.729 in short term. And the Aussie remained traded in an uptrend structure against the US dollar, but however the price was closed below the support level of 0.804. So this was suggesting to move further higher, to move further lower in short term as retracements. So the next support level we can refer to 0.8. Referring to the safe haven Japanese yen, it is remained traded in a downtrend structure against the US dollars, so it was gap up soon after the price break below the support level of 108, so it was suggesting to move slightly higher in short terms as retracements. So the resistance level referred to 109.5, and a closure below 108 again will be a signal for it to move further lower along with the downtrend and fall towards the next support level at 106 as long-term target. As for the commodities, the gold price remained traded in an uptrend, but it was retraced from recent high of $1,357 and currently traded between the both moving average line in 4-hourly charts. So it was failed to break below the support level of 1,321. Will be suggested for it to ranging between $1,321 and $1,357 in short terms, otherwise closing above the resistance level of $1,357 will be a signal for continuations of uptrend. As for the crude oil price, it was plunged sharply, with the West Texas Intermediate crude price retraced and plunged sharply from the recent high at $49.40 a barrel, and currently it was traded above the Fibonacci retracement level of 50 or the price of $47.50 a barrel. So closure below $47.50 suggesting for shifting trend directions become downtrends and probably to fall towards the max support levels of $47 a barrel. That's all for my analysis to date. Please don't forget to subscribe to our YouTube channel by clicking the GKFXPrime logo on the screens in order to follow our updated analysis and education video. Thank you for watching.
GKFX, your global trading partner.